Before the 2008 crisis, Michael Burry bought credit default swaps to bet against the MBS sold by the investment banks. Initially, the banks sold those swaps to Burry, thinking he was a fool to bet against the housing market and thinking they were getting free money. They charged him a high premium. But when his swaps became profitable, it was not easy for Burry to collect money from these banks. These banks tried to completely ruin his short positions and made his fund bleed. How exactly they tried to ruin Burry's profits, we will see in detail in this video. By the way, this video might get a little technical for some viewers with no finance background, so please be patient and pay very close attention. Now, let's see how banks tried to ruin his short position. Before betting against the market, Burry had studied all the bonds to the individual loan data. He bought these swaps from 6 banks to diversify and minimize risk. He did not even go to the banks like Lehman because he knew they had too much exposure to these bad MBS, and he assumed Lehman would fail or would not be in a situation to pay him back. When the bank sold him those swaps, the bank's job was to evaluate the price of those bonds daily. It is known as mark-to-market. It means you revalue an investment every day based on what it would sell for in the current market. For stocks, it's easy to evaluate price because the price is public. But Burry was dealing with mortgage-backed securities, and MBS weren't traded on a public exchange. They were traded over the counter directly between the buyer and seller. Therefore, the banks determined the prices of those bonds. If the bank said the bonds were stable and still at their original price, then on paper, Burry's swaps weren't worth much. That meant the banks didn't have to pay him anything, even though the real-world housing market was already starting to decline. This became a problem for Burry's swap contracts because they required payment adjustments based on those daily valuations. If the market price of the bonds went down, the banks owed him money. Since the banks themselves controlled the pricing process, they marked the bonds high for as long as possible. That way, they avoided paying Burry while still collecting the hefty premiums from him every month. Because of mark-to-market, Burry could be right about the long-term collapse of these mortgage bonds, but still lose money in the short term. The ABX index was the other thing from which Burry could figure the MBS prices. But banks also manipulated the ABX index as much as they could. The ABX index prices were based on actual MBS trading between big Wall Street banks and a handful of institutional investors. As the MBS and swaps trades happened directly between the counterparties, it made it very easy for banks to manipulate the ABX index. If the banks wanted the ABX to stay high, all they had to do was trade small amounts of MBS at inflated prices between themselves or with friendly clients. The ABX index simply reported prices, and a few well-placed inflated MBS trades could easily manipulate the ABX index. Burry knew that banks were manipulating the index because he was observing the actual home loan defaulters and foreclosure data, where people were defaulting on their loans, but the index was stable and the value of his swaps was also the same. Banks also used the ABX index for justification that the housing market is stable and tried to delay Burry's payment. The ratings agencies also played a huge role in dragging out Michael Burry's pain by delaying the downgrading of the MBS. Their ratings were critical because many institutional investors, like pension funds and insurance companies, were only allowed to hold BBB or higher MBS. The moment an MBS was downgraded below that threshold, those investors would be forced to sell, which would flood the market with MBS and crash prices. Then it instantly triggers payouts on Burry's credit default swaps. But instead of reacting quickly to rising mortgage delinquencies in 2006 and early 2007, the rating agencies kept those high ratings in place for months even after the data screamed that the MBS were losing value. This delay by rating agencies was not accidental. Rating agencies were paid by the very banks that created and sold these MBS, which meant downgrading them early would hurt their own biggest clients. The agencies also feared that a sudden wave of downgrades would cause a market panic, which in turn would bring more public and regulatory scrutiny on their business. For Burry, this was infuriating. Without downgrading MBS, there was no official signal that the bonds were risky, which meant banks could keep saying that the MBS were at their full value. This made it almost impossible for him to collect payments on his swaps in the early stages of the crisis. The banks leaned hard on this loophole. Every time banks priced the bonds just slightly higher, they used to send Burry a payment call for premium, demanding millions of dollars. His fund, Scion Capital, had limited liquid cash to cover such demands, so repeated calls quickly became a threat to his survival. If Burry ran out of cash, the banks could force him to close his swaps early, locking in a loss and erasing his chance to profit. This way, they tried to wait him out, hoping he ran out of money for premiums. Burry's battle wasn't just with the banks. It was also with his own investors. As 2006 and early 2007 dragged on, the ABX index showed that MBS weren't falling much in value. So on paper, this made it look like Burry's credit default swaps were a bad bet. Every time the ABX ticked higher or stayed flat, it signaled to investors that the housing market was in good condition and that Burry's trades were bleeding cash. His investors, who didn't fully understand the complexity of MBS and the games being played, became restless and angry. They saw his fund paying out millions in premiums to the banks while getting nothing in return, and they began demanding that Burry should close the CDS positions immediately to stop the losses. Burry, however, was certain that his analysis was correct, and it was just a matter of time for the housing market to crash. But he also knew that if too many investors pulled out their capital, he wouldn't have enough cash to pay the premium, and then he would be forced to close the trades at exactly the wrong time. So Burry invoked a clause in his hedge fund's agreement to suspend withdrawals for a year. This meant investors couldn't take their money out from Scion for 1 year. It was a drastic step, and some investors also threatened to sue Burry, but ultimately this move protected his swap positions from closing early. It bought him the time he needed to survive before the market collapsed. The breaking point came in mid to late 2007. Michael Burry had been watching the data, and defaults in adjustable rate subprime mortgages were rising fast. The defaults were so high that the banks and rating agencies couldn't hide it behind inflated valuations anymore. Because of this, ratings agencies began downgrading the ratings of these MBS. Once those ratings fell, many institutional investors were forced to dump their holdings all at once, flooding the market with toxic MBS that nobody wanted. The ABX index, which tracked these MBS, also tanked. At almost the same time, a crucial change in the mark-to-market rule came. Before, banks were pricing MBS based on their internal models, but after this change in rule, banks had to price those MBS according to current market value. This tanked the value of those MBS even more, as they were already losing value. At this point, Burry swaps became very valuable. The market was now factoring in the bad MBS, and Burry could have waited until the bonds officially defaulted and collected the full payout over time as the defaults rolled in. But instead of waiting for every default to play out, Burry decided to sell those swaps, and the banks bought back the swaps from him for their current market value. So overall, Michael Burry made $700 million for the Scion Capital Fund and $100 million personally. One of the most remarkable parts of Michael Burry's story is not just that he was right about the housing market collapse, but that he was right about exactly when it would happen. The mortgage data he studied in great detail, Burry saw that millions of subprime loans had been written with low teaser rates that would reset to much higher payments after 2 years. That meant the wave of defaults wouldn't be random. It would spike at a very specific point in time when borrowers can no longer afford their mortgages. By mapping these reset schedules and combining them with already rising default rates, Burry predicted that the real damage would start in 2007. This timing was critical. If it had been even 6 to 12 months too early, delayed ratings downgrades, and pressure to pay millions in premiums could have drained all his fund's cash and forced him to close the position at a huge loss, despite being right about the housing collapse. The man everyone thought was crazy was proven right. His investors walked away with hundreds of millions. And the banks? They had no choice but to pay him every cent. Michael Burry didn't just beat Wall Street, he made them pay for doubting him. If you want to learn more about the 2008 crisis from start to end and how some people benefited from it, then check out this video.